housing market isn't collapsing because of buyers, it's collapsing because of fear and uncertainty. In July, over 58,000 home purchase agreements were canceled, the highest July rate ever recorded. Stick around as we pinpoint where the damage is spreading and how you could protect your money before the next wave hits.
So this is interesting. Let's look at the data. So we have deals collapsing across the country, 22% in San Antonio, 21% for Lauderdale, 19.9% in Jacksonville. Also shows a supply spike of 24.8% year over year. That's a national number. Beyond that, we have pricing weakness. Listing prices fell in 33 out of the 50 largest metros, cities like Austin, Miami, Chicago, and Los Angeles. But prices are still inflated, 37.6% higher than in June 2019. So the big question is, where do we go from here? We've got this weird scenario where prices are still high, but deals are falling apart.
Yeah, I think it's interesting. I still go back to like the 2020, 21, early 22 when interest rates were low and prices were up, and it felt like prices were going to go up forever. And I think people have short-term memory. I think people assume that interest rates were going to be low forever. And I think even, as an investor, I definitely don't think that people anticipated interest rates doubling. But I think for the last several years, we've been at this weird place where buyers want heavily discounted prices. They're going, interest rates are up. I can't afford this property. So they want a discounted price. But a lot of these sellers are saying, hey, my neighbor sold their property for X amount of dollars, whatever, in 22 or 2021, 2022, like I want that for my property. So there's almost like this unrealistic expectation from both a buyer and from a seller. And I think we're kind of getting to that place where buyers and sellers are seeing that, hey, this is not 2020, 2021, 2022, where money was cheap and things were just, flying off the market and being outbid. And so I think some of this is just a pullback. You're seeing sellers get a little more realistic. You're seeing buyers being a little more realistic. There's not these heavy discounts, but there is some pullback and some repricing in a lot of these markets, especially these markets that have had hyper growth.
That's a good point. And I think, when people look at the housing market, everyone's always asking the question, is this the same as '08? Are we seeing the signs of '08? Are we seeing, this initial cracking in the marketplace where the whole thing's going to, fall apart? And I would say no. I don't know. I'm curious to hear your opinion, but I think that we're built on solid fundamentals or more solid fundamentals. In other words, when people went to go get bank loans, they actually looked at their credit, they looked at their W-2 income, they looked at the underlying fundamentals versus 2008, the run up. And prior to that, they were handing out loans like candy. I mean, it was sort of ridiculous. So I don't think that we're seeing like the initial cracking, which is going to take us into a 2008 scenario. But when prices go up, they have to stabilize, and there's almost always a correction within a couple of years. I think we're seeing that correction. Beyond that, though, we also have other things in the economic sort of like macroeconomic environment that are maybe cracking the psychology a little bit or the confidence a little bit. Jobs data, and we've had inflation data all over the place. Now it's up. A couple months ago, it was down. A couple years before that, it was at 8%. I mean, things have not been exactly stable. So I think that a slowdown in the housing market is just an indicator of people's psyche more than it is anything.
Yeah, and I agree. Everybody always wants to compare what's going on in the market to 2008. I think one of the biggest differences, like when you look at 2008, the run up to 2008, like anybody could get a home loan. So like you're talking 2003, 4, 5, 100% financing loans. Like I benefited from this. I came out of, 2008 fine because I still bought smart during those years. I bought for cash flow. I wasn't speculating on prices going up forever. But I think the big difference, like when you look at the lending environment, 2003, 4, 5, so we're going back like over 20 years. They were giving these shit loans to homeowners, not some investors as well, but these were typically like a lot of primary home type loans. And these were like short-term money, right? We had like 3%, 3-year adjustable loans, 5-year adjustable loans, all these things, 100% financing over leverage. So at some point, those loans matured. Those loans came due. People had to refinance. and they couldn't. And that's what really collapsed, 2008, where all these bad loans. I mean, I got a ninja loan. I got a 80% loan from one bank, 20% from the other, and 100% financed. I think the difference, like, in 2020, 21, 22, like those years, people were locking in 30-year fixed mortgages at low interest. So I actually think a lot of these sellers don't need to actually sell. I mean, now some people, they move, they get a different job, but a lot of this low interest money in the single family world, in the primary residence world, that's locked in for 30 years. So I think a lot of these sellers that put a home on the market, hoping to get a high price, even if they don't, their mortgage isn't going to change. Their payment isn't really going to change. And a lot of these sellers don't necessarily have to sell. I think it's different when you're looking at commercial real estate, which we invest in. With commercial real estate, these aren't typically 30-year fixed mortgages. And we've talked about this on past shows. Usually it's a 25-year amortization, and those loans are typically due in 5 years, sometimes 7, sometimes 10. There's some, some nuances to that, but usually those mature in 5 years. So I'm less concerned about, what's happening in these big metros and, San Antonio, Fort Lauderdale, Jacksonville, as you mentioned. That's less interesting, less concerning to me as an investor on primary single family residence, as I'm more interested in like what's going to happen to the commercial space as those loans start to mature. And we've talked about this on several past episodes.
Yeah, I think it is. I mean, it's interesting looking at the single family market, because I do think that's a leading indicator of psychology, but you're right. A lot of these people are sitting with amazing loans. I mean, I was, 2012, I got an awesome 30-year fixed loan on my property. It's at 3.25%. It's like, I don't ever need to sell that home. Now, if you're, a baby boomer and you're trying to retire, or you're moving on, or whatever, maybe you go sell the home and you recycle that debt out. But I do think the biggest area where this affects folks is the commercial market. This is where, like you said, it's a 5, 7, or 10-year loan term. If you're lucky, you have to be prepped for that. And we have talked about that. I think that a lot of people in the commercial market are feeling that. We've seen it. I've seen it amongst my own friends where they just can't afford the new debt. And so again, going back to the question, is this the first sort of cracking, and is it going to look like 2008? I don't think so. I know that right when I was starting to get loans in 2012, I've seen, I think, an increasing tightening of the banks. In fact, the last couple months, our loans have been, or the bank process of qualifying for the loan has been pretty strenuous. Like, they go through everything. They've gone through my whole schedule of real estate, past taxes, everything that they're really, so to me, the fundamentals are pretty strong, but we're still going to see cycles in the marketplace.
Oh my God, banks are tightening crazy. I'm in the middle of some refinances as well, and one of the banks, I mean, it's like a full cavity search. I mean, I think it's good. Banks should do their due diligence. I'm not against that. I mean, it keeps you honest as an investor. But some of the stuff they're asking for, and how many years they want to go back, and just under a microscope. I mean, it feels like a full cavity search. I think banks are getting a little scared. It's interesting though. I mean, at the top of the show in the intro, I mentioned July, 58,000 home purchase agreements were canceled, making up 15.3% of all pending sales. What's interesting about that, like, just because something goes pending and then, the purchase is canceled, it doesn't necessarily directly affect that home loan. So, going back to like these 30-year fixed loans that were locked in at low interest, just because the purchase was canceled, it doesn't necessarily put the seller in the position that maybe sellers were in back in, say, 2008. And so I actually think it's extremely different on the single family side. Again, the multifamily side, I do think there's a lot of people that are hurting. There's a lot of investors that are finding themselves underwater because they didn't, they were not buying these properties on sound fundamentals. They were buying these properties on hope appreciation and the idea that rents could just skyrocket forever. And yes, rents go up and prices do go up, but a lot of people made these big bets on commercial real estate with short-term low interest money. And now the properties are backwards. And I'm really curious, like, how are the banks going to react to that? How are investors going to react to that? I mean, I'm seeing investors, some investors are giving properties back to the banks saying, hey, we want to work with you. We actually don't want the properties back. And as those loans mature, it'll be really interesting to see how that impacts the global real estate market as a whole.
Well, I think that, I think there's a reason that 5% or maybe less people make it really big in real estate, because I think that 95% or 90% or whatever that is, look at real estate through the lens of like, oh, real estate's good investment, so I'm going to go buy real estate. But the fact is, you've got to look at these properties and underwrite them and understand how to cash flow them so that you can hold them for the long term. And, I've looked at, even prior to entering the real estate sort of investing world, and then even today within Elite, we'll have people join us in the Elite Mastermind that go, hey, here's my portfolio. And I look through the portfolio and I'm like, it's really obvious that you bought on speculation this entire time. We're not cash flowing here. Here's a vacant piece of land. Here's a development property. Here's a spec house, right? So I think that people look at real estate investing and they see it through a specific lens, and that lens usually keeps you small and it keeps you broke and it keeps you stressed. When you switch your lens, and we talk about in the book, The Mastermind, we talk about on the podcast, when you switch your lens to sound fundamentals underwriting based on cash flow, right? Cash flowing above the cost of ownership and the debt, then you have the ability to hold for long term. And I think that's a very minority of investors. Most investors, when they buy a property, they buy a new job, or they buy technically a cash flow liability. So, hey, I bought this awesome Airbnb. I'm going to rent it out and do this thing, but it still costs me $100 or $200 or $500 per month and time. So it's a time and a money liability versus the other way. And so I think this is what zero to 100 is all about, is like, how do you become the minority of investors where we hit these market cycles, whether they be price cycles or interest rate cycles or both, and you hold for the long term? And I think that people, during the run up, we look like, sometimes I've gotten shit for the way we invest, because you're like, oh, like, dude, you're too conservative, or like, what? You're a cash flow investor? I'm not a cash flow investor. Like, I've heard that so many times, where I talk to a broker and they're like, oh no, I don't sell cash flow properties, or whatever that is. It's kind of like this like concept that's not that popular, but it gets really popular when everyone's losing their properties, right? Because you're the last one standing. And so I do think it's interesting to look at this data. It's interesting to see how this affects commercial real estate. And the fact that things are resetting and people can't hold properties is a big deal, because you're talking about people's wealth and people's lives.
Yeah, I mean, I think it'll also create opportunities for investors. I mean, I always reference my, kind of my 2009 to 13 time period, where I bought a lot of properties. Actually, everything I purchased 2009 through 13 was all no money down seller financing. And, I reference that time because, this is literally right after 2008, like 2009, I start really picking up my buying, and my focus was only cash flow. And so many people, real estate investors and non-real estate investors, are like, isn't this risky? We just had this, real estate crash 2008. And I'm like, I am buying these properties for cash flow. I'm purchasing these on sound fundamentals with a cash flow first mindset. And I'm structuring this deal so that the property puts money in my pocket every month. And the worst case scenario is I cash flow these properties. I'm not setting up a deal based on needing to sell, needing to refinance, needing the values to go up forever. I told so many people from 09 through 13, I'm like, I don't care what the value does on paper. Over time, it will go up, but I don't care. I don't care what it looks like on paper, as long as, it's putting money in my month or in my pocket every month. And those properties continue, a lot of those I own today still. They still cash flow today. Rents have only gone up. Values have gone up. But it's the cash flow that allowed me to hold these properties. It's the cash flow that allowed me to keep these properties and not be in a position where I'm going, shit, I got to go give these back to the bank. So, I think, when you see some of these markets where prices are pulling back, or homes are pending, and then the sales are getting pulled, it's an opportunity for an investor. It's an opportunity for a buyer to come in and be creative. If that seller still wants to sell and there's buyers out there that want to buy, it's an opportunity to be creative. Maybe that's an opportunity for seller financing. Maybe it's a partial bank financing loan and a part, seller financing loan, so that the seller still has the ability to sell that property, but you have, as an investor, have a more creative way to get into this property and, create an opportunity for this property to cash flow that maybe wouldn't with, just standard typical bank financing terms.
I agree. And I think it's like, when you boil all this down, you can look at all the macro data all you want, but it comes down to the deal, and you can make a good deal in any market. Some are harder than others. That might be true, but you can make a good deal in any market, any economy. Right now, I think there's more opportunity than there was even last year, though. And we made good deals last year, but I think there's probably a greater propensity to make good deals today because there's more fear in the market. But when you think about negotiating a good deal, you are the solution for that seller. So if the seller has a problem, or or has certain needs or requirements or desires with that transaction, I like to get away from sort of the negotiation and turn it into more like a partnership. How do we partner together to get to the end of this thing where I take the keys and we both high five, we both feel good about it? Because I think that a buyer can go in and be a solution. So is that a long-term annuity through a seller contract? Maybe. Is that a higher price but better terms? Maybe, or a bonus for the manager, or taking care of certain tenants, or however that looks. I think that buyers have the opportunity to go in and be the solution for that seller and to set them up for success and give them an exit that they want. I know when I go sell my properties, I'm looking for a buyer that's going to be a good steward of the property. They're going to give me what I need out of it, whether that's price or terms, and somebody that'll work with me versus try to beat me up the whole time. So as you go negotiate and you be these buyers, or you're a buyer, make sure that you're being a good partner and a good, a good partner so you can move from zero to close in a way that benefits both parties.